All right. Hello, everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another Velocity Banking review right before we go to sleep. It's almost midnight. My goodness. And that's what we do at the most odd random times of the day, which is being debt free and doing spreadsheets over and over again. All right, so let's go ahead and get started. What is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. And the whole point of this is to pay off debt. So you create a budget, income, expenses, leftover savings, and then you create your expense breakdown, right? And then you list every single debt that you have in a line item. And then at the very last line of your budget, you just kind of put an average of all of your expenses, food, gas, insurance, and all that other good stuff. And so the way that I always present this is not like, hey, look at this thing called velocity banking. That's really cool. All I do is ask, hey, if you make good money and you have a lot of debt, and let's say you only have $256 left over a month, do you need to make more money, get rid of your debt? Right? That's kind of like, most people will just say yes, right? And I can't even think right now because I think it's now midnight, but most people will say yes. So what we do is we take the same income, same expenses, and actually, I already did this from last time, but I'll do it again. Same income, same expenses, and the number one rule is we don't save money. Oh my goodness, look at that. We don't save money. So if you ask the average person what's better, saving $256 or zero, they will be like, "Oh, well, at least you're saving some money, right?" And what we're going to do is we're going to put all of our money into debt with the help of something called a line of credit. So if you take a look here, you see this big fat zero? See, if people had this type of money coming in, and this may or may not be photoshopped, wink, wink. No, but if people have this money type of money coming in, they'd be like, why don't you save 1,000 or two? And what we do is we just dump all of our money into the line of credit. So as soon as money comes in, it just goes out. Okay. And so we're going to have this number called cash flow, which is income minus expenses, which looks like our savings, but it's not. Okay. And so, what we're going to also assume we have access to something called a line of credit. So, what's a line of credit? All it is a financial tool where you can borrow money, pay it back, and then use it over and over again. That's all a line of credit is, right? And so if I do this, and let's move these credit cards here to the line of credit, okay? These four credit cards, so that's 15, 27, 30, 10. And then I'm going to go ahead and sum this up. So that's $82,000 worth of credit card debt. Okay, we're just doing a balance transfer essentially. Guess what happens to these credit card payments? Oh my goodness, they all go to 0. And so we look at this. How do we literally go from $256 of savings and 39 cents or $256.39 of savings to 0 savings to $2,998.89 of cash flow? How'd that happen? We didn't get rid of the debt. All we did was transfer it. Okay. And then the final step is you put your entire $6,500 into that line of credit, and then you take your expenses out, and then you rinse and repeat over and over again. Right. So basically, when you dump 6,500, it satisfies the minimum monthly payment, and then it lowers the interest because it's based on the average daily balance. So what we're going to do is we're going to go ahead and do this and minus 2998.89. And then what we're going to do is take the average daily balance, multiply it by the interest rate, and then you divide by 12. And then I'm going to go ahead and copy and paste, and then copy and paste. And then I'm going to do this. So at 31 months, we have it all paid off. So 31 months. Um, all right. So 31 months, and How much should we pay off? All right, it's 82,000. Okay. That was easy. Okay. And so here's the thing. Don't get the wrong idea that if you have a lot of debt with $256 left over, that somehow the bank's going to give you a $95,000 line of credit. 97% of the time it's not going to happen, and I'll tell you why. You see, I have $604,000 in lines of credit. Soon, I actually might have a lot more than that. Well, I don't know if it's a lot more. In fact, it's probably actually, let me see if I can calculate it. I'm too lazy to calculate. I'll probably get 120,000 more. But right now, I have over $604,000 in lines of credit, and look at all the oodles and oodles and oodles and oodles of credit. And so, what's the secret to getting all this credit? Is you have to just give people what they want. You ever hear that phrase? Just give the people what they want. Well, in this case, replace people with banks, right? And here's what banks want. They want to lend money to people who don't need it. Okay. Banks don't lend money to people who need it. So if you understand that principle and understand, like, hey, oh, I see what you're looking for, then you could get a lot of credit. I got over 600,000. I'm probably going to have almost 700,000 by next month, probably, because I don't need money. And so because I don't need money, they give it to me. Anyways, all right. So let's go ahead and do this. And so if you see right here, we have our loan calculator, and there's only two loans here: car loan, mortgage. So this would be relatively easy. So we moved the car loan into the line of credit, and we're gonna get $500 back in Z cash flow. And I'm gonna do this, Control V, and I'm gonna do this, and then this is gonna be plus 15248.13. And then what happens to the car loan? Well, this goes to zero, right? And so now this is 3551.39. So this is our new cash flow here. And I'm gonna just do this, and I'm gonna do this, and then all right. So now let's update our cash flow to 3551.39. And then I'm gonna copy and paste, and then wablam, wablam, 35 months. It's paid off. So 35 months, and do this, and actually 35 months, which is 82 plus 30, and then 112K. And so in 35 months, right? So 35, that's $210,000 left in the balance of the loan. Now we have a 3% loan, so got to be a little bit careful. If we're going to use a line of credit to pay off this 3% loan, we don't want to move the whole thing into a line of credit, right? And I'm going to show you why with this Velocity Banking Calculator, which I kind of pre-filled in already. You just kind of put in the loan information, how much you're going to move into line of credit, your income, your expenses, blah blah blah. And if you don't know where I got this from, I got this from Renatus, which is originally where I learned Velocity Banking. And yeah, so I don't even know. I can't even think right now because it's like midnight. But the whole point of this is that hopefully, something about me selling education, click the Google form link below, possibly indoctrinate you into my cult. I think I can't even think. Anyways, all right. So, oh yeah, I get a commission off of selling Renatus educational products. Blah 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 blah. Anyways, so let me go ahead and look here. And so if I move the whole 3% loan into the 8% line of credit, look at this, I'm paying 43 grand. That's no bueno. Whereas if I pay $7,000 and move it into the line of credit, it makes a huge difference. And the crazy thing is, if I pay $7,000 of the loan into the credit, let's say a 30% credit card, that is still less than a 8% dumping all of the loan into the line of credit. So we got to be careful about saying loans bad, lines of credit good, and just pay all of your loan into a line of credit. Okay. All right. So, 4.2 years, 4.4.2 años. You want a quick Spanish lesson? Okay. I got the Spanish keyboard. So, hold on. I wonder if it's for, yeah, I see that. Okay, you wanna know the difference between this and this in Spanish? So in this means year, right? This means year, whereas this word means this. Okay. Why am I giving a Spanish lesson? Anyways, so let's go back and do this 4.2 years. So bam, 35 divided by 12 plus 4.2. Dang, 7.12 years debt free. Isn't that cool? We're 7.12 years debt free and we became mortgage free once we actually started focusing on the mortgage in about 4.2. Almost as impressive as, I'm just going to go ahead and flex because that's what I got to do every single video, which is paid off my mortgage in 2 years and 9 months. Wait, what's that? Are you new to this channel? Well, if you're new to this channel, you can go ahead and stare at my mortgage I paid off in 2 years and 9 months. Yeah, yeah, yeah. And banks don't lend money to people who need it. That's why I have over $600,000 in lines of credit. I'll have $1 million in lines of credit soon. I'm pretty sure I will. But you know what? I realize I'm not in a rush to do anything. You know, making a lot of money. I guess it's I don't know. I can't. I think it's kind of overrated, but maybe it's just me, or maybe I'm just, you know, I always tell you all this. I'm either rich or I pretend to be on YouTube. But anyways, all right. So let's go ahead and for today's Korean Atlanta mentorship, yeah, I did pay off my mortgage in 2 years and 9 months. I know, stare at it, right? Feed my ego. Okay, well, yeah. So Korean Atlanta mentorship. I'll see you on the next video. It is 12:11 a.m. and I'm ready to go sleep.